You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the Deep Dive. Our mission today, well, it's pretty straightforward. We're diving into a really comprehensive global briefing stack. It covers pretty much everything: currency wars, commodity pressures, right through to some genuine geopolitical flashpoints. You sent this material our way because you need that crucial context. What are the markets really worried about this week? And the answer, honestly, right from the jump, seems to be political chaos.
Yeah, the tone is, well, caution is paramount, isn't it? It's almost entirely driven by the U.S. calendar.
Right. Specifically, that heavy focus on labor data and the very real threat of a U.S. federal government shutdown.
And if you zoom out a bit, what's fascinating here is how all these global and local issues, everything from Japanese interest rate talk to pipeline flows in Turkey, they're all being filtered through that single lens, that lens of U.S. political instability. The pivotal catalysts for traders this week, they aren't just the economic releases. The sources are explicitly defining them as the tone of the upcoming U.S. labor data, any concrete movement or, frankly, lack thereof on government funding.
And how assets react.
And critically, how quickly safe haven assets and the dollar react to those shutdown headlines. That's key.
Exactly. So the market isn't just reacting to economic reality anymore. It feels like it's aggressively pricing in political friction, which I suppose brings us right into foreign exchange. The dollar's already showing some signs of vulnerability.
It is. The greenback, it eased back from those recent, data-driven gains.
Yeah.
And it actually slipped below its widely watched 50-day moving average.
That 50-day mark, that's important, right?
Yeah, very important. Because for traders, breaching that technical trend line, it signals a real shift in momentum. It suggests the focus has completely pivoted away from celebrating past U.S. economic strength.
And now it's all about the future.
Now it's laser focused on those future employment figures and just the sheer risk of a political funding failure. I mean, the dollar is weakening on the threat of, self-inflicted wounds.
Okay, so looking at the major currencies then, the movements seem largely dollar-led for now.
That's right. The G10 group, the world's 10 most heavily traded currencies, it shows the euro firmer, but really that's more of a dollar inverse move. There are limited, genuine euro area catalysts right now.
And sterling?
Sterling's also higher. It's edging just above that 1.34 mark.
Yeah.
Marcus is looking ahead to some domestic fiscal remarks expected out of London later this week.
But the big story, you mentioned Japan.
Yeah, the real story in FX this week, I think, is the Japanese yen. It's leading the G10 gains. And the catalyst here, it wasn't data, it was rhetoric.
Okay.
Bank of Japan board member Noguchi. He stated that upside risks are becoming more important in policy deliberations. And, crucially, that the need to adjust policy has heightened.
Wow. That language sounds highly significant. Why does that specific phrasing cause the dollar-yen pair to, briefly break below support near 149?
Well, because for decades, the Bank of Japan has been the global standard bearer for ultra-dovish policy. They've consistently resisted rate increases.
Right.
So a statement like this, that the need to adjust policy has heightened, is not just rhetoric. It feels like a seismic internal shift. It indicates the hawks within the BoJ are gaining real ground.
So even a hint is huge.
Exactly. Given their historical dormancy, even the hint of policy change is massive. And now, everyone is keenly watching the upcoming BoJ Tankan survey for some concrete evidence of this shift.
Okay. And outside the majors, what about the Aussie and Kiwi dollars?
Right. The Antipodeans, that's just market shorthand for the Australian and New Zealand dollars, they recovered modestly. And markets are assigning a pretty low probability of a near-term rate cut ahead of the Reserve Bank of Australia decision. So basically, they aren't expecting any sudden softening from the RBA.
Got it. And China?
And in Asia, the Chinese yuan found some solid support. This was after the People's Bank of China, the PBoC, set a stronger than expected daily fix.
Explain the fix briefly for listeners.
Sure. So the PBoC sets this daily reference point, the fix, for the yuan. When they set it stronger than the market expects, it basically signals the central bank's intent to manage the currency's stability. It helps prevent excessive weakness and provides a sort of crucial anchor for regional flows.
So we've got all these currency movements, a potential BOJ shift, strong yuan management, but they still seem largely anchored by that U.S. political thread.
Absolutely.
Our sources made a point of explicitly watching President Trump's meeting with congressional leaders and that warning he issued that the country closes if no funding deal is reached.
And that headline, it immediately translates into dollar and safe haven sensitivity. The market is using that risk as a clear floor for volatility, you could say. It's just hard to bet against instability when a government funding failure is being openly discussed like this.
Okay, let's shift gears now. Commodities. We're dealing with a completely mixed picture here, aren't we? And it's a crucial contrast, I think, illustrating this political risk trade. Crude oil is firmly under pressure.
Yeah, quite a bit of pressure.
Yet gold has pushed to stunning all-time record highs.
Let's break down why crude is lower. There are basically two distinct supply factors hitting the market, sort of simultaneously. First, you've got reports that OPEC Plus will likely raise their October production quotas by at least 137,000 barrels per day. That's a clear increase in supply expectation moving forward.
But hang on. If we started this saying the global risk tone is cautious, maybe suggesting potential future economic slowdowns, why would OPEC Plus decide now is the time to raise quotas? Doesn't that suggest they're, unconcerned about a global slowdown?
That's a really good challenge, and it shows the complexity here. The quota increase, well, it could suggest OPEC Plus might be trying to get ahead of renewed production elsewhere, or maybe they just see firm enough demand for now to absorb the increase.
Oh.
And that leads us to the second, more immediate supply factor. Signs that Iraqi crude flows via Turkey's Ceyhan pipeline could resume. That could potentially add, 180,000 to 190,000 barrels per day back into the system pretty much immediately.
Wow, that's significant.
It is. Baghdad has signaled it could lift exports once that key line restarts. So you have anticipated future supply increases from OPEC Plus combined with this near-term injection of supply from a resuming pipeline. Both are reinforcing that downside price pressure on crude.
Right. And against that softer oil backdrop, here's the real sign of the market's current fear. Gold. Pushed to a fresh all-time high, hitting near $3,820 an ounce. That is a truly massive move.
And the analysis of why gold is soaring, it directly reinforces our whole introductory thesis about political risk. The drivers for gold's record high, they're not just the standard weaker dollar and, lingering geopolitical risk.
It's more specific.
Yeah, more specifically, gold is pricing in the duration of the uncertainty surrounding the U.S. fiscal timeline, that shutdown threat we keep talking about.
So it's not just friction, it's potential chaos.
Exactly. When markets buy gold aggressively like this, they aren't just worried about, procedural friction. They seem worried about systemic disorganization. Gold is sort of the ultimate asset immune to political dysfunction, right?
Oh.
It provides safety not just from inflation, but from the inability of governments to fund themselves or manage debt responsibly. It's like the highest expression of the current political-led market.
Makes sense. We should probably also note copper, a key industrial metal. It's only modestly firmer.
Yeah, just modestly. It's getting a little help from the softer dollar, but that general cautious global risk tone we've been discussing, it's definitely capping its overall movement. Industrial demand seems to be waiting to see the outcome of this political drama before really committing.
Okay, now let's pivot our focus again. Active disputes in global commerce. Section 3 is all about the, thorny world of trade and tariff negotiations. The complexity and the high stakes here are really palpable in the source material.
Yeah, definitely. We have a significant tension brewing between the UK and the US over pharmaceuticals, for example. London is apparently prepared to pay more for medicines, trying to diffuse tension with Washington and the major pharma firms.
And the White House?
The White House, meanwhile, is using a massive point of leverage. They indicated a 15% tariff cap for pharmaceuticals under existing trade deals with the EU and Japan. But the source documents note the real threat here.
Which is?
Absent a deal, Britain would otherwise face staggering 100% pharmaceutical tariffs.
100%. That's a highly punitive figure. For you listening, that 100% is likely the maximum tariff allowed under certain trade laws. It's being used as a powerful threat, essentially, to force the UK to agree to Washington's terms on medicine pricing. It's extreme negotiating leverage.
And we're seeing this kind of active retaliation globally, not just there. China, for instance, has halted U.S. soybean purchases.
Yeah.
That's a classic move, right? apply economic pain directly to U.S. agricultural states.
Yeah.
It just underscores the ongoing trade dispute strain.
And it's not just China. Across the channel, the UK is facing heat from Brussels, too.
That's right. The EU is weighing a tougher stance on UK steel. There are proposals to have tariff-free quotas and double duties to 50%.
Ouch.
And separately, South Korea confirmed it rejected a U.S. request for, get this, $350 billion in cash tied to some kind of tariff reduction arrangement.
So all three examples just show that these zero-sum, high-stakes trade negotiations are active right now across multiple continents.
It's truly a stack of cumulative tension, isn't it?
It really is. Okay, let's dive into our final section, the geopolitical undercurrents. These are clearly driving that risk premium we see in gold and just feeding the general market caution. These flashpoints, they influence every global risk assessment.
Focusing first on NATO's northern flank. The situation there sounds tense and quite technical. Denmark reported unknown drones operating over several military sites. Yeah. And this immediately prompted planning for an EU-funded, networked drone defense architecture. NATO has also signaled a specific intent to boost its military presence in the Baltics, directly in response to this perceived threat.
Right. Turning to the Russia-Ukraine conflict, the volatility there just remains incredibly high. Moscow launched extended missile and drone strikes deep into Ukrainian territory.
And Kyiv reported its own counterstrikes. Apparently, UAVs hit a Russian oil pumping station way over in Chuvashia.
The volatility was so high that Poland actually briefly closed its airspace amid the overnight barrage. That just shows the spillover risk is immediate and tangible.
Yeah, absolutely. And politically, President Zelensky expects new EU sanctions this week. On the Russian side, Foreign Minister Lavrov argued there will be no return to Ukraine's 2022 borders.
Which just underscores the fundamental differences, right? They continue to block any path toward de-escalation. Both sides seem to be reinforcing their maximalist positions.
Exactly. No easy off-ramp there.
Okay, moving to the Middle East. We have some movement, apparently, on the conflict in Gaza. The White House's 21-point Gaza plan is said to be nearing finalization.
Yeah, the outline mentions a permanent ceasefire, a staged Israeli withdrawal, some kind of non-Hamas governing mechanism for the territory, and regional funding to manage the rebuilding effort.
There's always a but.
Well, while Israeli officials acknowledged that, yes, there has been progress in the talks, they also cited that significant gaps remain, particularly over the in-state conditions and security guarantees. So, strong diplomatic effort, but certainty remains elusive.
Got it. And a crucial point regarding Iran and nuclear issues. A Russian-Chinese bid to delay the reimposition of UN sanctions failed at the Security Council.
That's correct. It failed. Tehran, for its part, maintained that nuclear energy remains a national need. They confirmed they haven't withdrawn from the Non-Proliferation Treaty. Meanwhile, European capitals issued warnings against Tehran taking any escalatory steps in response to the sanctions snapback.
That failed bid sounds highly revealing.
It really is. It means the sanctions automatically reimposed. And the fact that two major veto-wielding members, Russia and China, couldn't even delay them, highlights the current deep fracture within the Security Council, especially regarding shared regulatory consensus.
Okay. And finally, wrapping up geopolitics, Asia. Tensions still high.
Yes, tensions remain high. Beijing is expected to press Washington to explicitly restate its opposition to Taiwan independence. That's a perennial friction point. And just demonstrating the border sensitivity, South Korea fired warning shots at a North Korean commercial vessel that crossed the maritime boundary. It's just a reminder that military engagement risk remains, well, volatile.
Okay. Wow, that was a full briefing stack showing just how intertwined finance and geopolitics are right now. Let's try to recap the key takeaways for you, the listener. The week ahead looks intensely reactive, almost entirely centered on U.S. labor data, and maybe more importantly, any movement or lack thereof toward funding the U.S. government.
Yeah, and to synthesize the big picture importance, the fact that gold is sitting near record highs, and we're seeing significant volatility in key supply headlines like oil before a single piece of major U.S. data has even landed. It just demonstrates that markets are overwhelmingly responsive to political and fiscal instability right now. This is, without a doubt, a politics-led market at the moment.
Absolutely. And building on that political point, let's leave you with one final thought to maybe mull over. We saw that Russian-Chinese bid to delay UN sanctions against Iran fail. allowing those existing sanctions to snap back into place.
Mm-hmm.
So given the extensive list of global trade disputes and these ongoing geopolitical conflicts we just covered, what does that specific failure signal about the current state of cooperation among Security Council members? If the world's major powers can't even agree on delaying existing sanctions, what are the broader implications for global regulatory stability, especially in the face of ongoing conflicts? That's maybe the deeper layer of risk to watch this week.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.